Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
Welcome, everybody. This is episode, let's see. What's the episode number? 83. Sorry about that.
Yeah.
82, this one. And then we'll record 83 right after this one. Wow. It's been almost a year or over a year since we started this.
Yeah.
Yeah. How do you feel, Hari?
Good. I mean, we get emails every week from people saying how much they like it and what they'd want to see on the podcast. So we're very excited to do that. And, we have a Slack channel available that people are messaging us and giving us feedback. So we're really happy about that. And, if you haven't gotten access to it, you can always email us, info@valueinvestor.org, and we can hook you up.
We can set you up with the Slack channel for sure. Yeah. It's been really fun, starting this, and now we're into the 80th, 82nd, 83rd episode. So on our way to 100 shortly. So before we start on today's episode, can you give us a disclaimer quick?
Yeah. So this is the Value Investor TV podcast. We are a podcast that helps you understand how value investing works and the principles behind it. We are not your financial advisor. We don't know your financial situation. So if you are making important financial or tax discussions, you should have that with the appropriate person.
Yeah. Excellent. Okay. In this episode, this is something, as I told you, Hari, before we started this podcast, this is something kind of personal for me. When we were working together, we would have these sort of one-off conversations over lunch or just, reading through code together. We would have these one-off conversations about what's happening in today's newspaper, anywhere ranging from politics to business to opinion piece, things like that. So I wanted to take the opportunity here in this podcast to maybe do that. Since we no longer work with each other physically, I thought this might be a good venue and opportunity to do that, and maybe share with our audience our thoughts on various news that's swirling around us today. So we picked a couple of articles from Wall Street Journal to talk about in this episode. First, we'll talk about kind of the Berkshire Hathaway, the ever-growing mountain of cash that they're hoarding, and the problems that is associated with that, and how we think about it from Value Investor. We'll talk about that first, and then the second article we will talk about is this is something that we constantly talk about in our evaluation of companies. But a Wall Street Journal article recently published talked about this, and that is when companies go through hard times, they tend to split the CEO and chairman role. When the times are good, it tends to be one single person that serves both as a CEO and also as a chairman. But the article talked about when times are tough, companies split chairman and CEO roles. In fact, that's exactly the title of the article. When things get tough, companies split chairman, CEO roles. So we'll talk about that after the Berkshire Hathaway. Cool. Hari, let's just jump right in. I think this is going to be more of a casual kind of conversation between you and I.
Yeah.
The first article, Berkshire Hathaway, the article titled "Berkshire Hathaway's Cash Pile Hits a Record." This is a Wall Street Journal article that was published this weekend, November 2nd. What's your thought on this? Maybe if I could just give listeners some color. Their cash reserved, Berkshire Hathaway cash reserve hit $120 billion in cash or short-term treasury as of September 30th. So what's your kind of take on this ever-growing mountain of cash in Berkshire Hathaway?
Yeah, so I think, I don't follow Berkshire Hathaway all that closely as a company because I won't invest in it. I mean, I think it's always interesting to listen to what Warren Buffett has to say. And, Becco and I went to the annual meeting 2 years ago. We didn't get a chance to go this year, but so I guess that was 2018 that we went, but we didn't go in 2019. But I hope to go in 2020. And Buffett actually talked about that even 2 years ago because he had this large cash pile. The thing about Buffett and Munger, and I've read every annual report and every chairman letter since they've been public, he's remarkably consistent, right? He will sit on money and cash until he finds companies that he can buy, and when he had $100 million company, in the 60s, it was a very different ball game than trying to hunt down at when you have 100, or I guess it's more like a $400 billion company. You have all this cash. If he went and bought a $500 million market cap, it has no impact on the bottom line or no, impact on what's going on to the Berkshire shareholders. So he's going to have to look for big companies that he has bought in the past, like Precision Castparts, and the railroad that escapes me right now. Is it BNSF?
Burlington Northern?
Yeah, Burlington Northern, BNSF. These were, very, very large purchases, in the multiple, tens of billions of dollars. And he makes these purchases because he is able to, he's probably one of the few people who's able to do this, right? So the thing that he says a lot is he has to compete with private equity firms. So private equity firms will leverage up. So for those of you who don't understand how they operate, they will take, Toys R Us is one I've mentioned many times in the podcast. A company bought Toys R Us and they actually went to the bank and said, we will leverage up Toys R Us's bank balance sheet in order to, so all of this money that we are going to take out to purchase Toys R Us to pay off the current owner of the company. We will leverage up, take out a big loan from the bank or from a bond or some other vehicle, and use that money to pay for the investment. And then that money will be paid off over time. Now, what happens usually is private equity firms do this, then they fire a bunch of people, reduce the value of the business, and then try and sell it. It'll polish it up for a couple of years, but won't really invest in the company anymore. And then they'll say, oh, look how much more profitable we've made it, which they haven't actually done. And then they sell it off. So Buffett doesn't do that, right? Buffett walks in and he says, you have an ongoing concern that makes so much money. I can estimate what it's worth. And I want somebody to run that business because I don't want to be in charge of running it. And so he'll pay them some amount of money, and he's going to be very strict about how much he spends. And a private equity firm can take a bunch of debt and pay, more than, what Buffett does. And eventually that company may go under or what have you. So a lot of what we see with this is Buffett has a very small number of companies that he can buy. Those companies that he can buy are very expensive because of interest rates and other, factors. And he's only looking at the very best companies. And typically the very best companies charge, get a premium in the market. And so I think that's why we're seeing him sitting on cash for so long, is that it has nothing to do with, the market is expensive or whatever. This is my opinion. I mean, I don't, as far as I know, he has not said anything like this. There isn't, whales to hunt at this size that he can afford, right? He's going to have a very strict set of criteria, and he's willing to let deals go by because a private equity firm will pay more, and he has a cap.
Yeah, exactly. I think a couple of things that you mentioned there, I do want to kind of mention one more time. In terms of private equity, I think that was one thing that you mentioned. And then the other thing is there's only so many of them that Berkshire can buy that is going to make any dent in their portfolio, because they're basically managing in the hundreds of billions. So buying, $50 million company is not going to do anything for them.
Yep.
Just the sheer size of Berkshire Hathaway. So those are two kind of separate but related threads that you mentioned there. One thing about private equity firms and kind of the leverage buyout kind of strategy is that it is inherently short-termism.
Yep.
Right. Like you're looking at leverage buyout. You're looking for some sort of exit liquidation opportunity in the next 3 to 5 years. That's kind of how they operate. So with that in mind, with that constraint and kind of angle, with that angle of approach, then you tend to have this short-termism. So that's why you leverage up and then you dump it at the end of 5 years and you make handsome profit and then you walk away. Whereas Buffett, to your point, Hari, is much more long-termism. And that's where, value investor kind of thinking about it as the owner of the business. That's how that is in contrast to what private equity firms do, to your point. All right. And one other thing that you mentioned, the second thread, just the sheer size of that, just the sheer size of company that Berkshire requires to make any dent in the portfolio. To me, that's pretty. I mean, when the amount of money is like you're surpassing like 9-digit, 10-digit, 11-digit. To me, it's all like just blob of money. Like
right.
For me, I just can't even fathom what that looks like. It's just many zeros after a million, and then just more money.
Yep.
Yeah.
Well, and I think just going back to that short term, long term, right? The way that we try to emphasize that to you all is short term people care about the price, long term people care about the cash flow, right? So the cash flow is how Buffett makes money off of his businesses. And a short-term person will think about the price of the business, and that's the only thing that they care about. So it's easy to manipulate things in the short term to 1 or 2 years. But imagine if you stopped capital expenditures, you stopped spending on the things that needed to maintain the business, let alone grow the business. You may get a tailwind from previous investment, right? So the company prior to that purchase has invested in marketing, has invested in infrastructure, has invested in keeping things up, and then they slowly let that go away. I mean, I don't know if you shopped at Toys R Us before they closed down, but you could see that, right? Toys R Us was a profitable business, but they didn't have any advertising. They didn't have any mind share, right? For a long time, it was just fading on the idea of it being around. And it wasn't until I had kids that I even went back into the store, since I was a kid, and going in there, I was like, wow, this is a really great store. It has all these toys that I couldn't find anywhere else, but nobody knows about it. They didn't do any of that investing. And so you slowly, all that momentum that you build up is what you coast off of. And then eventually it just catches up with you. And that's essentially what happens with a lot of these private equity business deals is they have to exit, because if they don't exit, then it's going to the leverage is going to end up hurting them. And so what they try and do is pay off the debt, or they'll sell it after they've loaded up on the debt. They'll sell it to someone else who's now it's their debt problem instead of the private equity firm. So
yeah, just kind of pulling on that thread a little bit more on their strategy. Because the strategy hinges on, this kind of leverage and leveraging up to juice up their bottom line or free cash flow, I wonder in the kind of stepping back and thinking about it from kind of macro environment perspective, in the era of low interest rates, private equity firms, what do you think about, the success of private equity firms in the era of very low interest rate, because their strategy is so tied to levering up, they might find it easier to pursue that strategy because of the ease of lending environment.
Oh yeah,
what do you think about that?
They are able to get more cash much easier, and they are also able to justify higher valuations because of the low interest rates, right? And so, in their mind, it's free money. Except inherently what you're doing is harming the actual engine that generates the cash flow that you would use to then pay down the debt, right? And so heavily leveraged companies, like we've talked about companies like Kraft and others that have tons of debt where effectively they're paying off, a third or half of their earnings are just going, their operating revenue is going to, or operating profit, I should say, is going to interest payments. Right?
Yeah, just purely interest payments. And forget about principal.
Yeah, and at that point, really, who owns the business? I would say the debtors own the business.
Yeah,
right?
The banks
and the bondholders and the everybody else. So I see a lot of people levering up. The balance sheets in the early 2000s were a lot cleaner than they are today, and we are seeing a lot of businesses that levered up to do dumb things. Essentially pay dividends to if you ever see a company borrow money to pay a dividend, you should just avoid it. I mean that should be an immediate red flag. But they're borrowing money at the peak of the stock price to pay back or to buy back shares.
That's another thing.
Yeah, it's one of those things where they say, "Oh, this is a shareholder friendly thing." Well, if you're indeed doing that, I think GNC is the best example that I can think of right now. They borrowed over $1 billion to buy back shares when their stock price was at $60 a share. They did the buyback, and then the stock price cratered to like $3 a share, and so did their free cash flow. And so now it's a question of, can they survive with meager free cash flow and pay off, their debt? And who's going to loan them money at this point when, they have already a bunch of debt and meager, and declining free cash flow? So, who does the borrowing, whether it's private equity or not, it really doesn't matter. You still owe this money. I mean, imagine if you have student loan payments, right? Your inability to get a house, or your inability, and we're seeing this amongst, people in their 20s and 30s, they're unable to get a house because they have $200,000 in student loan debt. Well, it's no different for a company, right? You're having to spend all your money to pay off interest payments, and you're not even really making much of a dent in the principal, right? And that's fundamentally the problem here.
Yeah, exactly. And just one more comment on this before we move on to the next article.
Yeah.
I recently read a book, and I posted the book in our Slack channel. I'm forgetting the name of it. It's something to do with private debt, and this is something that one of my coworkers recommended. And it basically talks about how private debt is the cause of the cyclical nature of our economy. You go up and then you come down, this private debt. And I think a good example of how private debt really is just hurting the engine you talked about, like the core engine, and how that's, at just explicit display is Japan.
Yep.
If you look at Japan, the private debt to GDP, it's like 250% or something like that. And US is below 150%. Right now, because Japan is basically they have this mountain of debt on top of their shoulder, above 250%. I don't know the precise number, but it's very, very high. The country and all the economic engine that has to be revving up it's just not doing it because they're just so sagged and just, cracking under the pressure. And that's why you're seeing this long sagging performance of Japanese economy and Japanese companies for the past 2 decades.
Yeah, and I think in the U.S. I've seen numbers of, private credit card debt and student loan debt are, in the multi-trillion dollar amounts now. And I mean, imagine that when you're trying to do anything, right? Yeah. How I mean, I see this a lot with people, right? Is, they buy a car and they buy a new car, right? Which is automatically more expensive than a non-new car, like used car. And then they're also borrowing money to buy it, right? And so effectively nobody's saving anything because they are up to their eyeballs in debt, and they're using leverage to even pay for things that I mean, let's be honest. You don't need a new car, right? I don't care how much money you make. You can go buy a used one and get a third off, on the price, right? It comes. This applies to everything, right? You get a degree in something that you rack up $150,000 in debt. Well, I have a medical degree and I have that same problem, right? I mean, I have to pay it off. Now, fortunately, in medicine, you can actually make real money and pay it off. But, there are people who had, you would say the same thing about law school or other things. It effectively does the same thing, right? You have to be able to sacrifice for a long time to make money as a lawyer or as a doctor or as other things. But you may not get there, right? You may burn out. You may have other things that come up. And there's risks associated with it. So anyway, we would be talking about this all day, but I think
let's do it. Yeah.
I think just the last point I'll make is, be very wary of these companies that are levering up, right? Anytime that they say they're going to borrow money to do something, just be wary of that, because any CEO will tell you, and they'll tell publicly, yeah, we're borrowing money to do this. This is a great idea. Let me tell you why, right? And you should always look at that and say, why don't you just do it with the free cash flow that you generate as a business? And if you can't, then maybe you shouldn't do it, So
yeah. Let's end there and move on to those are really good points there, Hari. So let's move on to the next article, which is titled "When Things Get Tough, Companies Split Chairman, CEO Roles." This was again Wall Street Journal article that was published November 3rd. A subtitle: "From Boeing to WeWork, a record number of big U.S. companies are dividing their leadership roles, often after a crisis." So just as the subtitle highlighted, from Boeing to WeWork, some companies I just want to mention: Boeing, AT&T, Wells Fargo, Nike, Under Armour, and of course WeWork. I think we talk about this a lot in our podcast, Hari. The fact that when a single person, CEO, is also a chairman, except for certain situations, it can be problematic. Because the role of a chairman is to kind of oversee the executives. And if that person is one and the same, you have kind of a conflict of interest there. So let's get your take on that.
Yeah, let's actually talk about what are the acceptable reasons that you would want to see a CEO and a chairman first.
Sure.
And then I think we can walk backwards and talk about why it's such a bad idea, right?
Yeah.
So the only time that I would be okay with it is if the chairman actually owns a majority of the shares of the company. And the reason for that is you want an owner of the business to be able to invest alongside them, right? If they have a significant stake in the company, then decisions made at the board level and at the executive level should align, right? Because they are going to align to maximize shareholder profit, right? And so what will happen in those situations is the CEO of the company will make the decision that is not benefiting him personally, is benefiting everyone at the company, right? Now imagine the flip side here, which is you have a chairman who is brought in, who owns nothing in this organization, and he's also the CEO. Well, the chairman of the board's job is to hire the CEO and is to pay the CEO, right? Is to determine their incentive and compensation structure, right? Mm-hmm. So what will happen in that situation is if I'm the chairman of the board and I'm the CEO, well, I'm just going to set the compensation to suit me best, right? How am I going to profit out of this? I don't really care if the company wins, because at the end of the day, I make the most money, right? Now,
and they have minority stake, very, very small stake in the company in your situation.
Right. Now, if they bought their way in, right, into the company and bought a large stake in the company, then I'm totally fine with it, right? It doesn't even have to be a majority. It has to be a very large percentage of their net worth has to be in this organization. Mm-hmm. Because then they benefit from good decisions in their share price will increase, right? And that is how everyone should be thinking, right? Is how do we align the incentives of the CEO to do the right thing, right? We've used the example of the oil and gas companies where the CEO says, I want my incentive structure to be based on the number of barrels of oil that we pump. Well, at $150 a barrel, we make tons of money. At $40 a barrel, we lose money. But all I care about is pumping as many barrels of oil, right? So that is a clear example where the chairman has a different interest than the CEO, right? And when their interests are aligned, then it makes perfect sense, right? If that CEO owned a large percentage of that oil company, he would say, clearly, I don't want to pump oil at as many barrels of oil at $40 a barrel, right? And so that is how you kind of align everybody's incentives here. Is if they own a big percentage of the shares, then they're going to do what will maximize their overall return, which is also maximizing the share price.
Yeah, for sure. Yeah, it's interesting. It's all about incentive alignment from all the way from top to bottom, right? Top all the way from the board level to C-suite and all the way down to employee level. I think that's what's important here. What's interesting about this article is it's basically the title, When Things Get Tough, Companies Split Chairman and CEO Roles. It's interesting. The incentive alignment has to happen through the hard times or in good times. And it seems like the article is pointing out that when things get tough, companies realize that, well, maybe we need to look at incentive alignment and see everything is ironed out. What do you think about that part there? Ari?
Well, I think what it tells you is that this is what I've seen a lot happen is companies will encounter a rough patch. They'll fire their CEO. They'll bring in a new CEO. And what that CEO, and they'll say, you'll be the chairman of the company, right? And I think they said 47% of the S&P 500 have dual role, chairman, CEO, right? The other 53% have split or have never had it in the past, I think was what the statistic said. So what they're doing is they hire a CEO. CEO comes on and they say, well, we really like you. We want you to turn things around. Let's work together on making your incentives work, right? Now, a CEO is going to look at that and say, okay, I'm working at this new company. I'm going to do whatever it takes to maximize my money, right? And so maybe you're already in a hole because this is a business that's not doing well, right? So they bring in a CEO, they elevate him to the CEO chairman role. As the chairman, he sets his own compensation, right? And he's going to maximize his return for himself, not necessarily for the other. But what he will also do is actually, board composition at publicly traded firms actually turns over fairly quickly, right? People have to leave because of conflicts of interest, or they're no longer able to for work-related reasons, whatever it is. And people on the board typically get paid a lot of money. Now, if you're the chairman of the board, what you will do is you'll bring on people who are yes men, right? Who will maximize your own compensation. And what you're seeing in this article is these were all people who were brought in as chairmen and CEO, dual role, and the board looks at them and says, you're trying to bring on your own people, and you're not doing a good enough job. And that's why they're trying to split up the thing, as if this is a good governance idea, right? But this is a good governance practice, whether things are good or bad, right? And people shouldn't be thinking about this as a times are good or times are bad, so we should do this. It's what is the incentive of the CEO and the chairman? Are they aligned? And if they're not aligned, then they should be separate roles, right? And that should be the only test that you have for this.
Yeah, exactly. It's not when the times are tough you have to make those decisions. It's every time.
Yeah.
It's every year, every review cycle. You have to make sure, as the board responsibility is to make sure that the C-suite and the board incentive is 100% aligned with the shareholders. And I think it's, kind of fiduciary, obligation for the board to look after shareholders and to maximize shareholder returns. And if they don't do that, that's exactly opposite of what they should be doing.
Yeah.
Just for the record, in 2019, so this year, S&P 500, percentage of companies in the S&P 500 index with a separate CEO and chairman is 53%. The lowest, the graph is available in Wall Street Journal, goes all the way back to 2005, and at that time it was 30% and has been steadily going up. Okay. Anything to add to this episode, Hari? I think those two were the ones that we wanted to cover in this episode.
No, I think I think if you're interested in discussing any of these topics, we'd be happy to chat about them on Slack, or send us an email. Either way, or if you find another article unrelated to these and you want to bring it up, Becco and I post things in the Slack channel all the time, and we'll have discussions, and whoever wants to join in is more than welcome to. We always like hearing other people's opinions. So
yeah, email us at info@valueinvestor.org to get that Slack invitation, or just email us if you have any questions. Awesome. Thanks guys for tuning in. We'll see you guys in the next episode.
All right, thank you.